You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Bootcamp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. Most options trading platforms are commission-free, and there are some that don't charge per contract fees. Public.com goes a step further. When you trade options on Public, there are no commissions, no per-contract fees, and you get a rebate of up to 18 cents per contract traded. That means it costs less than $0 per transaction. In other words, instead of paying to place options trades, you literally earn money, and that money can add up fast. If you trade 1,000 option contracts on Public, you'll earn up to $180 in rebates. 10,000 contracts? Up to almost $1,200. It's pretty obvious why NerdWallet recently gave options trading on Public 5 out of 5 stars. Because Public really stands out for the cost of its options trades. Their words, not ours. If you want to start paying less than $0 to trade options, check out Public.com and get a rebate of up to 18 cents per contract traded. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures in podcast description. U.S. members only. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody. Welcome back to Education Wednesday. That can only mean one thing. It is time for Options Boot Camp. And today you're not getting just one episode. Nope, you're getting two, another double header. So all of our pro folks hanging out in the pro live stream. You'll be getting this episode and the next one straight into your ear holes. No waiting. No rest for the wicked over there on the pro side. My name, of course, Mark Longo from the optionsinsider.com, as well as from the network upon which all of you folks are binging and mainlining these days. If you want to join the pro, hang out in the live, get the double headers early, get all the OIC content and everything else that comes out early. Also, great giveaways, like perhaps we shall do today with a pro trading crate out there, hint, hint, as well as all sorts of other fun. theoptionsinsider.com/pro is the place to go to learn more. And remember, if you like what you hear, this show, anything else on the network, throw a like, a star, a comment. It does help folks discover the content. We have been doing this for over a decade, so a lot of folks listening, but the more the merrier, including we got this comment coming in from KG on the Android App Store, which is important because our app has been up there for a while, but then it, you know, with the updates, we don't maintain the app, listeners. We have a developer do that, and I guess they got behind with the updates, so it wasn't on the store for a while. People were asking us, where's your app? Well, it's back. We made sure all the updates went through, so KG's loving it. She said, this is 5 stars, the gold standard in options, news, and education. Thank you, Mark and friends. Well, you're welcome, KG, and everyone else who takes the time to listen and rate and review out there. So a lot of fun to be had out there. If you're on the Android side or on the iOS side, there's an app for either of you out there. So make sure if you want to get the full network, the app is a great way to do it. It'll also get you all the back episodes with my cohort, the black-hatted one himself, Mr. Dan P. from Market Taker Mentoring. Mr. P., welcome back to the show, sir.
Hey, buongiorno, my friend. How are you?
I'm excellent. I'm happy our app is back on the Android side, so that's fun. People were asking for it, like, where'd your app go? And I said, I don't know. Where did our app go? So I had to go check. Sure enough, a lot of updates need to be done on that side of the fence, permission forms to be signed and all sorts of things that apparently our developer was not doing. So we needed to crack the whip a little bit. But it's back there now, listeners, if you want to get it. And speaking of getting things, Dan, you feel like Santa Claus today? You feel like giving away some prizes?
I always feel like giving away prizes, especially when, you're the one paying for it.
Yes, that's true. I am the one paying for the prizes. Oh, well, I'll tell you what. I just fired up the random number generator equating to all of our pro members out there. And Dan, you can choose whenever you want. You can do it now. You can do it a little bit later in the show. It's flashing on my screen right now. You tell me when to stop. And that will be the winner of our May Pro Trading Crate. Each one bespoke, each one pretty darn cool, if I do say so myself. Tell you what, Dan, why don't we let it simmer a little bit as we head on into the basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
All right, welcome to the basic training. And Dan, that was mean. I'm teasing the folks. They have to wait now. They have to wait now for their giveaway. But you just give me a little nod when you're ready to do the giveaway here. But we'll get into this week's topic here on the basic training. It's actually inspired by this question from Frank P. He says, hello, boot camp maestros. Ooh, maestro. You like that, Dan? You like being called a maestro? That makes sense.
Yeah, I like it.
We do speak a lot of Italian to each other in between episodes of the show, so I suppose that makes some sense. He says, loving this program that I just discovered. Oh, you're one of the many new ones out there. He says, I have a lot of archives to catch up on. Yes, you do. You got about a decade's worth, so strap in. You got some edumacating to do. He says, my question might be simple, and I apologize if you've already answered it. But if I want to capture a dividend using options, do I have to hold the strategy through X date or through the payable date? All right, a lot to unpack there. First off, yes, we have touched on dividends a number of times in the past. I'll just give you some recent episodes you folks can go check on if you can't be bothered to go through the full decade's worth of archives. Most recently, August 9th of last year, 2023, we did episode 249 entitled Meme Stock Redux and Capturing Unreliable Dividends out there. So that was a good one to listen to about dividend capture. We also talked on July 26th. So we did a couple of dividends back to back. July 26th of last year, episode 247, Strike Selection, Voodoo, and Surprise Crypto Dividends. I got a feeling that was about Bitto. November of 2022, we talked episode 210 about tail risk and dividend arb. January of 2022, we talked once more into the earnings breach. 170, we got into dividends there. 169, right before it, the mysteries of special dividends, January 12th. Of 2022. And then we talked episode 126 from March of 2021 about dividend adjustments, and we've had a few others in there as well. But that's just a quick rundown of the recent episodes we've done touching on dividends. Dan, this question from Frank P. is an interesting one. He wants to capture some divvies using options. He's not sure how long he has to hold the strategy, though. Does he have to hold it through the X date or the payable date, sir? What do you have to say for him?
Well, this one is a simple answer. You have to hold it through the X date. It has to be in your possession on the day of the X date. Specifically, the stock, and so you'd want to exercise calls. We'll talk a lot more about that as we go through this whole thing. But the payable date comes later, and the reason why companies do this is because, they have to get all the information from the brokerage firms to see who actually has this stock in their possession. And they got to do all this by hand with calculators or Abaci and send people on the Pony Express to send out the checks and all that. So that's why there's a big difference between the X date and the payable date, or at least that's what it used to be. I don't know why it's such a long time between the two dates now, but who knows?
That. Abaci. You don't get the plural of abacus very often here on the network. Dan, going for the Abaci. Yes, let's do a quick refresher on some dates for all of our newcomers out there. A bunch of different terminology around dividends may be confusing for you. The declaration date, that's pretty obvious. That's when they declare what the actual dividend is going to be, when it's announced. The ex-div date that Dan wasn't talking about, that's the key date you want to focus on for some of the strategies we're going to be talking about in a second. You have to own the stock. This is when people get hung up. You have to own the stock before the ex-div date. If you buy the stock on the ex-div date, if you do the option strategy on the ex-div date, ain't going to work out the same way maybe you hoped, because the ex-div date is 1 day before the record date. How do I know that? Because the record date is the day on which you must be a shareholder of record to receive the dividend. So that's why the ex-div date is always 1 day before that. And then the payable date, as Dan said, or the payment date, a couple different terms for that. That's when the dividend will actually be paid. And it confuses some people as well, because that could be weeks, months, not months probably, but weeks usually, sometimes between the ex-div date, at least a few days. And that always throws people off. Like, wait a minute, do I have to hold it all the way through when I actually receive the dividend? So I could see why there's some confusion on there. Speaking of confusion, this inspired us to go back and look at some dividend capture type strategies. Now, we have talked about dividend arb before. Most recently, like I said, back in episode 210 from 2022 about dividend arb. That's more along the lines of what the pros do using kind of wash sales and size verticals on strikes with high open interest in the money as a way to try to capture the dividend without any real risk. That's why you see explosions of paper and certain names on their X date or right before it. And it's not really a viable strategy for retail. We've talked about that a million times before. You're not going to put in 10,000 plus contracts in a wash sale just to try to skate on a few hundred dividends. But a pro might do that. But now there are some ways retail can do it. There's a bunch of different ways. Let me ask you, Dan, before I get into some we have broken down here. When I say to you, dividend capture for retail, somebody comes to MTM, they say Maestro P, to go with our nomenclature from our listener here. Maestro P, I would like to capture said dividend using options. What's your go-to? How do you go about that?
Generally speaking, don't waste your time. Given our commission structure and, our just the requirements that retail traders have in doing business, I don't think it would end up being worth it for you. As a professional, a lot of professionals argue that it's not really worth it either. But for a retail trader, it's definitely not worth it.
So I guess let's end the episode now then. What do you think? We're just done.
Yeah, okay. Next episode, let's go.
12 minutes in for episode 1. All right. Dan's prohibition aside, which it is challenging. I do agree with you. People are still going to ask us these questions. So that's why we do the episode here. Let's start with some basic ways I've seen people try to approach this. They come in, they see a dividends payable, let's say XYZ, trading for $10. They announce there's a dividend coming at the end of this week. It's all very near dated in our example. And they're going to pay you $1, so a pretty hefty dividend, 10%. You decide, you know what, I want to get that dividend. I'm going to buy the stock. So now you bought the stock. That's one basic way to get the dividend now. But you also realize I don't really want to hold it for much beyond the X date. I don't really care about the stock beyond that. I just want to capture this dividend. So you turn around and you sell a weekly call in our example, a covered call. In our example, you get 25 cents for that. Again, you don't care about the stock. You don't mind it getting called away. So you sell an at-the-money call, a 10-strike call. You hope the stock gets called away. All you really want to do is capture that dividend. So a couple of pros to this strategy. First off, you're going to collect the dividend on the stock, $1. Plus, you're going to get the 25 cents extra boost, extra income. That's obviously $1.25. $1.25 on a $10 stock. That's 12.5% return in a week. That sounds awesome. Why wouldn't I do that? Now, some downsides to this. You can probably see this where I'm going with this. The stock obviously should drop on the X date by the approximately amount of the dividend. I say approximately because this is all voodoo at the end of the day. I've seen all sorts of weird things happen around X dates, and we can get into some of those stories in a bit. All right, then, to recap what we just did, we bought the stock for $10 at the beginning of the week. It drops to $9 to reflect that dividend at the end of the week. So we lost $1 on our stock position. Of course, we did also collect $1 in the dividend, so that's pretty much a wash. And then on top of that, we harvested 25 cents on those calls. Those calls are now $1 out of the money, so those are going out worthless. So we collected 25 cents net at the end of the day on this trade. So while not exactly a banger, you didn't capture the full $1, you did end up pocketing 25 cents on this trade. Now, of course, you can continue to hold the stock and hope that it appreciates and makes back that dollar that you lost, in which case you'd be $1.25 to the good. But in this example, you managed to walk away with 25 cents. Again, bear in mind, this is an optimal example. It very rarely, if ever, plays out this way in real life. We're just trying to show you some easy examples with some easy to follow moving parts. That said, Dan, what are your thoughts on using covered calls to capture, or in this case, attempt to capture a dividend? Now, I have said I have done this strategy with some decent effect in high div names like Bitto. And again, those are kind of weird. Bitto's looking at a 50, 80% dividend yield right now, which is just bonkers. So sometimes you can have success in those types of names. But in general, the covered call as a way to harvest a dividend is not always the best. Dan, what are your thoughts on this approach, doing the covered call and trying to do the dividend that way, to capture the dividend that way?
Oh, yeah. It's I don't know. I mean, honestly, I never really thought too much about it because the theory, the paradigm is, like you pointed out, that the stock opens low. Well, if it opens unchanged, it actually opens lower by the amount of the dividend, like up or down zero, the price is less by the amount of the dividend. So, and the price of the call then would theoretically not change because the call has nothing to do with the dividend. You don't get it, you don't pay it. So, I mean, in theory, it should just be a total wash. I guess the only difference is that in practice, I think we tend to see stocks rise after, after a dividend is announced and is paid and such. I don't know. I'm a little skeptical on it, Mark. I got to tell you.
Giving Dan homework here, covered call on the dividends. You're right. It should be, theoretically, it should be dubious. As Dan points out, stocks don't always behave as expected. In fact, I vividly recall an example. We were doing our Options Oddities show with the Rock Lobster there, and he and I had both gotten into some calls. I believe it was on Vale. He contacted me early in the week next week saying, hey, look out, big dividend coming. We got to get out of things. We got to bail on these things. He was freaking out. So I said, okay. So I go and I bail. We both bail on these calls. They were, I think, slightly out of the money calls at the time. I think the stock was around $11. We had maybe the 12s. I forget the exact strikes. And then lo and behold, the ex-div comes. And literally the next day, it might have even been a few hours later, Dan, the stock just roars and explodes north through our strikes. And we were both just like, what the? It defied all logic. It defied all theoretical knowledge you would have of the options market and the way stocks are supposed to perform around dividends. So that's why I always throw this caveat out there, is that, I mean, we would have been much better off holding the calls through the dividend, which sounds counterintuitive. But then the stock ended up blowing through the strikes and it would have been a huge winner. But of course we got out of him. Yeah, it's just these dividend times are funky. That's why I say all these theoretical examples are just that, theory, listeners. In real world, the practice is a different beast. Another way people like to do it is they have the stock. Let's say they own the stock for $10. They know the dividend's coming out. They declared the dividend $1 this week. They want to get that divvy. That's a nice 10%. Who wouldn't want that in a week? They also maybe don't want to take that big hit on the stock. So I've seen a lot of people coming in saying, what if I buy a put against the stock now? So in this case, you probably, if you want to do that, you don't want to go out too far. If the dividend's this week, you don't want to go out a year. That put's not really going to do much for you. You want to have something that lines up closer to the ex-div date. High delta, high gamma moves with the underlying out there. So in our example, you buy a 1 week. Well, let's go in the money because you want higher delta, right? So let's say the stock's at $10. You buy a 10.5 put, so 50 cents in the money. In our example, you pay 75 cents for that. It's a 75 delta as well. Everything lines up perfectly in our example. I love that. I love how that works. So you're paying 25 cents over, effectively, the theoretical value for that thing, which is a little bit pricey, but it lines up with the value of that call we were just talking about earlier. Now, the stock drops to $9. Everything works out theoretically perfectly on this example. $9 on ex-div date. So you have the stock, it drops $1, but you're collecting that dollar as well. So you're kind of net a wash there. You're long the stock, you capture the dividend, so you're kind of flat on that side of the trade. But you also have this put that went from 75 cents to now $1.50. You guys, obviously, it's a 10F put. Stock goes out at $9, so that's $1.50 in the money. So you know it has $1.50 worth of value. You can also look at it as a 75 delta moves $1. You get into 75 cents. So either way, the put goes out at $1.50. So now you're a wash on the stock, and you made 75 cents on your put option. So at the end of the day, not a bad do. This is the way I've seen people do this. Again, entire caveat out there being this is all theoretical. The stock has to move exactly the way it's supposed to. It has to go out exactly at these strike levels. Also, in the real world, if this dividend is not a surprise, if it's at all a regular dividend, guess what? There's no free lunch. Market makers aren't idiots. They know this dividend is coming. That's all going to be priced in to the value of that put option. So at the end of the day, the notion you can come in and buy some undervalued put right into the dividend announcement and then capture that dividend and make all this profit on the put. It sounds theoretically good. If you look online, you'll see a bunch of people advocating for this type of strategy. In reality, it really never works out the way that we've lined it up here. This is a theoretically perfect example. The put's going to have that value reflected already, and it's going to be really hard to make much of anything on this trade. Dan, what are your thoughts on using a put to do this in real life?
Well, I mean, that's the same thing too, man. The theory says that it shouldn't matter. And I mean, I think it'd be worse with a put. Well, no, I guess, yeah. I mean, the theory says that it shouldn't matter. And the thing is, like, there's never a free lunch when it comes to option trading. If there was, it would be an arbitrage opportunity and somebody else would do it, and that would force the price in line, and you would never even see it. And I don't think we see that happen. So I've got the same skepticism, man. I've got the same skepticism.
Are you a skeptical fellow out there? Well, yeah, the truth is these strategies are very difficult, if not impossible for a lot of retail to pull off. That's why the pros do it with their wash sale way. Again, we've talked about the dividend arb the pros do. Go back, check out those episodes. And even those are becoming fewer and farther between because OCC has grokked to that strategy over the years. They've seen a distortive amount of volume going up around ex-div dates and some of these names, and people didn't like it. It looked bad. Exchanges were using it to game the system and get some extra volume, extra market share. It wasn't a good look, so they've changed their exercise rules as well to try to get rid of some of those wash sales. So we're seeing that strategy decline on the professional side / institutional side as well. So at the end of the day, it sounds good on paper. You're going to see people talking about it online. Just go type in dividend capture or dividend capture with options. You're going to see a bunch of examples out there of people explaining how these strategies work so easily. The reality is not so much. I mean, again, market makers aren't fools. They know all the inputs to their models. They're not going to give you an underpriced put for free heading into a dividend. And then same thing with the calls out there. It's just, unfortunately, there's no real way to harvest that reliable free lunch. You might skate every now and then because, of course, as I mentioned, stocks are weird. But in general, it's a challenge. You know, it's also a challenge. It's getting Dan to have a good question of the week. Let's see if we got him with one this week.
And now, it's the moment you've been waiting for. It's time for the Market Taker Question of the Week.
All right, Mr. Dan, before we get into your question of the week, you want to do the crate now or you want to save it for a little bit still?
Oh, yeah. Stop.
Okay. Luckily, I had my hand near my mouse button, so I was able to I have the lightning reactions of a cat as well, so that also helps. All right, who did Dan pick? Let's see. Oh, you picked one of our newer members. They're going to love that. Mango Lover 75. I love that handle. I don't know. I've asked multiple times what the origins of that handle are, why he loves mango so much. Let alone in the year 1975 or just 75 mangoes. I don't know. Either way, I love that handle. Dan, excellent choice. Congratulations, Mango Lover. You win one of my favorite handles in the pro side. And also, you win the Pro Trading Crate. So our producers will be in touch with you. You get a bespoke, awesome Pro Trading Crate including a lock of Dan's here because we're just that nice here on the show. All right, Mr. Dan, while we go contact Mango Lover, what you got for our question of the week?
Okay. I am asked about this time to time because I guess this is a term that I coined that's sort of out there in the option trading nomenclature.
Mark Longo is extremely handsome and intelligent. You say that a lot. I know it's become kind of like a meme.
Yeah, let me think about the last time I said that. I might have been drunk. Well, let me run this one by the audience. What is a volatility mesa? And this is something that I kind of, I can't say discovered, I identified on volatility charts. And I identified it like after I started teaching options, not when I was a professional trader. Like this didn't even dawn on me when I was a professional trader, but with historical volatility charts on things like an earnings event or any volatility event that causes the stock to gap greatly and the next day's closing price to be like a way farther away closing price than normal. What happens is the historical volatility chart jumps up that day because it measures its standard deviation, the deviations between the closing price. And there's this one day that's a huge deviation. And that ends up, and then if the stock trades just with normal moves, normal volatility, the volatility just kind of stays somewhere around that level for the next 20. I mean, I use a 21-day historical volatility. A lot of people use a 30-day one. And then that number, that deviation day drops out of the calculation. And so we have something that looks like, you know, if you're out in Sedona, Arizona, like a mesa. And those are important things to understand because if you use the historical volatility figure during that mesa period, it's overly inflated. So you kind of have to either mathematically or at least mentally adjust for that. I wish I could show you a picture, but I don't know. I don't know what happens if you Google it, but you see these things on volatility charts all the time, and they're pretty important to identify.
All right, we are coming up against it for this episode. Don't fret, though, listeners. Another episode following immediately after this. If you're hanging out in the pro, there's no way for you at all. If you're hanging out on the on-demand side, don't blame me. Dan's got to travel, but you'll get it in your ear holes this time next week. So a little bit of abacus trivia for you. Fascinating bit of knowledge. And if folks want more knowledge in their lives, Dan, where should they go? What should they do?
Make your way on over to markettaker.com and join our community. It's a lot of parts of it are free. It's fantastic for people who are brand new to options, and it's really, really good for people who are experienced with options as well.
Check them out, markettaker.com. Don't forget the second T for Theta. And also, while you're checking stuff out, check out our friends over there at Public. They're liking hearing from you folks. They've already renewed beyond the initial scope of their campaign. They're liking it so much out there. So good to hear that they're liking the feedback from you folks. If you want to, I wanted to learn myself what they have popping off over there. So I did just sit down with the head of their brokerage on the network yesterday. That is hitting the network as we speak, listeners. If you want to hear more about that rebate they talk about at the top of the show, how does that work? How much can you actually make? What types of option strategies can you trade? What can't you trade? What kind of tools do they have? What are they working on? All that kind of stuff. I put it to all of them for you folks, listeners. The hard questions. So if you want to hear that, check it out on the full network. And then hit them up over there, public.com. Let them know you heard about them on this show. Goes a long way to keeping this flow of episodes heading your way. Speaking of that flow, we got another one coming at you immediately after this for the pro folks. If you're not on the pro, theoptionsinsider.com/pro, the place to go to learn more. Congrats to Mango Lover 75, the winner of our pro trading crate. Otherwise, we're back again next week for you on-demand folks. Another episode of Options Bootcamp. Stay safe out there, everybody.
Check out public.com if you want to literally earn money to place options trades. There are no commissions or per contract fees. And Public gives you a rebate of up to 18 cents per contract traded. Discover why NerdWallet recently gave options trading on Public 5 out of 5 stars. And start paying less than $0 to trade options. Only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures and podcast description. U.S. members only. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.